This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and look at the impairment within associates. And the principles, the rules are exactly the same. So what we wrote up before, remember, is that an asset is impaired or a cash generating unit is impaired if the carrying value is greater than the recoverable amount, isn't it? And the recoverable amount is the higher of the value in use and the fair value less cost to sell. Okay, that's the basic principle. We now just need to apply that into the world of associates. And the key bit that you've got now is that the associate is treated as an asset, and the value of the asset is the value of the investment in associates. So when you're looking here at your carrying value, that's the value of the investment in associate, which, remember, takes your cost, doesn't it, and adds on our share of A's post-acquisition amounts. Okay, that's why it's very important that we write that out, because remember, we're equity accounting for the associate. So when we equity account, we're looking at everything based upon our share, aren't we? Okay, so what we've got to be careful of here is, because the carrying value is taking account of our share, when we're looking at the value in use, we will be given the total value in use of the associate. Okay, and also the total fair value less cost to sell of the associate as well. Now, what we need to do there is, for both of those figures, we need to take our share so that we are comparing like for like. Okay, if we've taken account of our share within the carrying value, then we need to take account of our share within the recoverable amount. So it's vitally important that when you're given the value in use and you're given the fair value less cost to sell, that you take our share of it. Okay, that's it. And then once you've got the impairment, you just process the impairment. And what you might be thinking now is, that makes sense, because when in one of the very early videos we spoke about the impairment in the associate, we said we never take our share of the impairment given within the question. And the reason why is because when they have calculated the impairment, they have already gone through and taken our share. Okay, so it's addressed within the calculations. So once you have the impairment, you just process it and don't need to make any further adjustments. In essence, the adjustment has already been done for you. So what we've got there, it says calculate the value of NAVN to appear in the core group consolidated financial statements at December 2015. So here it doesn't want to work out the actual impairment. It says what's the value of NAVN. So presumably that is the value of the associate after any impairment. So what we've got here, it says Cork acquired 25% of the share capital of NAVN on the 1st of Jan 15. So that's the start of the year, for $5 million and exert significant influence. NAVN made profits for the year of $2 million and did not declare any dividends. So here, to answer the question, we've got to work out the value. So the cost plus our share. So it cost 5. So 5 million. We own 25% of, is it the post-acquisition profits, which were there as 2. So that gives me 0.5. So at this moment in time, the associate is valued at 5.5 million. Okay. Cork impairment tested NAVN at the end of the year, whereby the fair value less cost to sell was 16. The value in use was there as 20, wasn't it? Now, you've got to be careful there that you don't just throw in the 16 million and the 20 million and say, well, the higher of the two is the 20. The carrying value isn't greater than that 20 million, and therefore it's not impaired. Because remember, what you've got to go through and do there is you've got to take P share. So here, P share of the value in use is 25% of that 20 million. And just for completeness, the fair value less cost to sell was 16, wasn't it? So 25% of 20 is 5. 25% of 16 is 4, isn't it? The higher is 5, isn't it? So you have a carrying value, is it, of 5.5. The recoverable amount is less than that, so is that there as 5. So what you've got there is that there is an impairment, isn't there? And that impairment is the 0.5 million, if you like. It's a balancing figure between the carrying value, isn't it, and the recoverable amount. As the carrying value of 5.5 is greater than that recoverable amount of 5, the associate is impaired, and it is impaired to the amount of 0.5 million. To answer the question, though, it said calculate the value of NAVN to appear in the core group financial statements. It's that figure there. Okay, so it's 5 million that appears in the group SFP as your investment in associate, and that associate, I think, was called NAVN. So if you wanted, you could call it investment in NAVN. Okay, there we go. It goes on the SFP. It goes with the non-current assets. You know, PPE, goodwill, investment in associates. There we go. So just be aware of it. It does crop up every so often. There's not a huge amount of marks, but it should be pretty straightforward marks if it were to appear. Okay, you don't get little questions like that. That would be part of an overall bigger 35 mark group SFP or group profit or loss style question. And the information given in each of those examples that we've looked through in those last 2 videos would form part of the additional information. Other than that, I think that draws to a close the end of this chapter. Basic group structures. I think although the structure is very basic, parent, sub and associate, I think it's still quite technically challenging. So please make sure that you're really happy with this chapter here before we then go on any further, because if you're confident with this chapter, the remaining chapters become that little bit easier. I'll see you all in the next chapter.